Howdy, Jacob here. Today we're going to do a more in-depth analysis on PetMed Express. I've read their most recent couple quarterly reports and their most recent 10K and have pulled some notes from them. And this is just a reminder, I'm updating my analysis based on my review, but this is not an end-all be-all. There's still much more to do if you want to invest in this company. If it is in the realm of um, a good return for you when you do your own analysis, you're just going to have to do a lot more research. You're going to want to research a few more 10Ks, a few more quarterly reports, try to understand management better, try to understand their competitors and how they're not going to be kicked around like a can on the ground with their competitors. And for now, this is what I do in in-depth analysis. I don't go 100% in depth, but this is just reading all their reports, understanding the business, and then if it's a buy price, even from then you're going to have to research competitors. Probably do a couple more hours of research before it would make sense to truly buy them. But again, everything I say is my opinion. This is just what I believe will happen to the business based on my review. And let's review the numbers quick, and then I'll go over some of the notes that I took from their quarterly reports in 10K. So a $76 billion market cap, a bit lower enterprise value because their net debt is very low. We see on the balance sheet 55 million in cash on hand with no short-term debt, no long-term debt, and a little bit of capital leases. Their growth is very small. Actually, since 2019, they're down a little bit. And from a margin standpoint, both gross and operating are both down. We'll get into that more later. But return on invested capital pre-COVID was amazing, and then it's just got torn apart a little bit the last 2 years. From a free cash flow standpoint, CapEx is increasing. There was two large CapEx capital expenditures over here, but it is increasing. The company made an acquisition, a large net acquisition last year, and so that's going to be that's changing their earnings a little bit. And so let's go to some of the notes that I'm stating here. So on the dividend was suspended in October. So it looks like I either made this before that or maybe I didn't look at what the dividend was cut. And so we take out the dividend, and interestingly enough, they're not interesting, but focusing on organic and inorganic growth and initiatives. But interesting enough, they actually have been paying a dividend continuously since 2009. So this suspension is a pretty big deal for them, as it's been going on for almost 15 years at this point, or at that point was going on for almost 15 years. But they're really trying to get back to focus on organic, inorganic growth and use their free cash flow for that. They had a 9.5% revenue increase year over year. This was heavily driven by their acquisition of their Pet Care RX acquisition, or their acquisition of Pet Care RX, and was actually offset by PetMed's sales decline. About 50% of their sales are recurring, so they have memberships, they have auto options, and so half of their sales are on auto ship or whatever. Where when it comes to flea and tick, maybe every 6 months um, you need a new supply, and so you have it on auto. So that was kind of interesting. Half of their sales being recurring is pretty solid. For fiscal year 2025, their strategies are to focus on driving growth, improve profitability, and increase key customer satisfaction metrics. Pretty general. I kind of agree with all of these. I mean, you do want the company to grow, but more important to me is the profitability and the free cash flow. And it looks like, based on the initial free cash flow statement, or the cash flow statement, and the net incomes on the income statement, there's actually negative free cash flow and net income from the acquisition. So as of this moment, it doesn't look like it was a very great acquisition, because I don't care about hitting the top line nearly as much as I care about making the company more efficient and increasing the bottom line figure. Their market for vet care and prescription medication is $38.3 billion dollars, and the pet spending increased 7% in 2023 to $147 billion dollars. So it's definitely in a growing industry and business, but I think there is a lot of competition here. And, um, why choose one over the other? I don't know if there's any moats in this business, and they're really just going off of cheapest price. The average order value increased from $93 to $94. Not much to call out there, just a little bit increase in order value. Their reorder sales are 88% of revenue, new order sales about 9%, membership fees 3.5%. Okay, so membership fees are fantastic. That's recurring revenue. That's almost 100% gross margin in the business there. And for most of the revenue being reorders, that means you have people that are coming back to you. They're staying loyal, which is a positive. They have no short-term debt and long-term debt, as I stated, but their cash has been depleted a little bit from 104 million down to 55 million. Most of that decrease was due to roughly a 0% free cash flow margin. It was slightly negative for the rolling 12 year. And then 12 million to dividends, 36 million for the acquisition of PetCare RX. All of that happened in the last year. And so 12 million dividend, they took away the dividends, so it's no more. And then their 36 million acquisition of the PetCare RX, that's a one-time thing. So free cash flow historically was essentially all to dividends. So from a capital allocation standpoint, the previous 2 years, all the money that came in just went to dividends, and then this year, you had a good amount going to dividends, but then a huge acquisition, and so the company's going to have to focus on getting that cash basis up. But from a risk standpoint, the company has no short-term and no long-term debt. So as long as they can get back to profitability, it's terribly difficult for a company to go out of business if they make money and they have no interest bearing debt. I mean, they have capital leases of about whatever, $1 million. It's essentially nothing. And so when you have no of those type interest bearing liabilities or extraordinarily small and you make money, it's entirely difficult to go out of business. And so from a safe standpoint, I think it's a safe investment, but we'll see in a sec what I think about the um, present value of cash flow and income here. So sales are up 3% from 2022, but their sales general and admin expense is over 77% increase. I found that pretty crazy. So their acquisition of PetCare RX and just trying to get some organic growth has caused their sales general and admin expense to increase very heavily. So some of the new things, I mean, the company removed their dividends, so I had to zero that out. But they're really focusing on growth inorganically and organically, and so for that, I think a 3% growth rate seems reasonable. Maybe it's slow, but for me, I want to be a little bit conservative. Um, and then the 3 to 6% range on margin, I think is fine because it's been way higher historically, but they made a huge net acquisition, and it doesn't look like um, that acquisition makes any money, and so that's going to deplete your margin because even if it was 20% of sales, 20% of your sales negative, 80% at the positive, you're going to have to average that out. I think I'm fine with that. 1% increase of shares, fine with that. 11 on the PE because they now have a little bit of growth. Um, and then maybe let's do 12. So still below market average, but I just don't think growth is really there, and there's so much competition. And then I put a 17.5% discount rate because I think I need a little bit extra margin for me personally, based on the fact that their net income is zero, their free cash flow is zero, the of their last year, and so I don't feel entirely comfortable um, just getting a 15% return. I want a little bit of extra squeeze, a little bit of extra juice for the squeeze here. But we're saying the company's stock price needs to fall 43% before we get the price we're looking for after this in-depth analysis. And so it's still not, or it's not quite at a buy price from the in-depth. But I do hope you enjoy the video, and I hope you have a great rest of your day. Thank you.